Hi there! Discover how Holdover Relief can work with trusts, helping explain the interaction between inheritance tax and capital gains tax.
You've watched an investment property grow in value for decades, and you're ready to pass it to your adult child. But handing over the deed outright triggers a heavy financial burden that many families don't see coming. The UK tax system treats this gift as a sale at full market value. This creates a dry tax charge, a massive capital gains tax bill that falls due even though no cash was generated to pay it. Take a property purchased years ago for £120,000 that is now worth £340,000. That leaves you with an embedded gain of £220,000. An outright gift is classified as a potentially exempt transfer. While it might eventually help with inheritance tax, it triggers an immediate 24% capital gains assessment, leaving the donor with a $52,800 bill. Without a structural legal vehicle, a direct gift of appreciated property effectively penalizes the family by liquidating a significant portion of their total wealth. To bypass this immediate tax hit, you have to route the asset through a different legal structure, the discretionary trust. The strategy relies on a specific trade-off. To avoid paying capital gains tax now, the transfer must be pulled into the inheritance tax system. An outright gift sidesteps immediate inheritance tax, but guarantees that $52,000 capital gains bill. Moving the property into a trust deliberately triggers the inheritance tax regime instead. Section 260 of the tax code provides the solution. As noted here, holdover relief allows you to defer the capital gains entirely, provided the transfer is immediately chargeable to inheritance tax. Utilizing a controlled inheritance tax event provides the legal mechanism needed to eliminate the immediate capital gains tax burden. This works because of the nil rate band, the $325,000 tax-free allowance every individual has for these types of transfers. When the £340,000 property enters the trust, your allowance covers the vast majority of the value. Only the £15,000 overflow enters the taxable zone. At the 20% lifetime inheritance tax rate, that small excess results in a manageable tax bill of just £3,000. Because the asset is now within the inheritance tax system, that original $52,800 capital gains tax is fully deferred. By accepting a £3,000 entry fee, the donor avoids a $52,000 tax bill and successfully removes the entire property from their future taxable estate. This relief is not granted automatically. It requires a formal election using HMRC Form HS-295, filed alongside your self-assessment return. You must also meet the filing deadline, 4 years from the end of the tax year in which you made the gift. Even with the paperwork submitted, specific drafting errors in the trust deed can void the relief entirely. The most common mistake is the settler-interested trap. If the trust allows the donor, their spouse, or their unmarried minor children to benefit from the assets in any way, HMRC will deny the holdover claim. There is also a 6-year clawback period. If the trust becomes settler-interested at any point in that window, HMRC will retrospectively demand the original capital gains tax payment. While the Section 260 strategy is highly efficient, a single careless clause in the trust deed can transform this tax shield into a significant financial liability. The financial swing here is massive. A direct gift costs the family over £52,000 in immediate tax, whereas the trust strategy reduces that cash requirement down to £3,000. With April 2026 reforms set to cap major business and agricultural reliefs, many property owners are now moving to lock in these trust structures before the rules change. Managing the intersection of HS-295 forms and trust law requires specialized oversight. Our team at Pro Tax Accountant specializes in structuring these transfers for maximum efficiency. You can find our contact details in the description below. Subscribe to our channel for weekly updates on UK tax planning and wealth preservation strategies. Navigating the tax code with precision allows you to pass your wealth to the next generation without it being consumed by immediate capital gains assessments.